The 9 steps of accounting. Welcome to the overview of 9 steps of accounting cycle. In this presentation, we will explore each critical step involved in maintaining accurate and reliable financial records. These steps form the foundation of accounting practices and ensure the financial health of the business. Identify the transaction. The first step in the accounting cycle is identifying transactions. Every business transaction, whether it is a sale, a purchase, or an expense, must be recorded. Source documents such as invoices and receipts provide the evidence needed to identify these transactions accurately. Proper identification ensures that the company's financial records remain reliable. Recording transaction in the journal. Once the transactions are identified, they are recorded in the journal using the double entry accounting system. Each transaction affects two accounts, ensuring the accounting equation remains balanced. It is crucial to accurately record debits and credits to prevent errors that may affect the accounting cycle. Posting to the ledger. After transactions are recorded in the journal, the next step is to post them to the ledger. The ledger provides a summary of all transactions, giving a clear picture of a company's financial status. Ensuring accuracy in this step prevents discrepancy later in the process. Prepare an unadjusted trial balance. An unadjusted trial balance is prepared to ensure that the total debits equal total credits before adjustments are made. This step helps identify any errors in posting and provides a preliminary review of the company's accounts. If the trial balance doesn't match, common troubleshooting techniques must be applied. Next off is adjusting entries. Adjusting entries are necessary to ensure that revenues and expenses are recorded in the correct period. Common examples include accrued salaries and depreciation adjustments. These entries ensure that the financial statements reflect the true performance of the business. Continuing with the adjusting entries. Adjusting entries typically include deferrals and accruals. Deferrals involve postponing the recognition of revenue or expenses to the correct period, while accruals involve recognizing revenues and expenses that have occurred but not yet been recorded. Depreciation of tangible asset is another critical adjustment made at this stage. Next, we are elaborating on the deferral of revenue. A deferral of revenue occurs when a business receives payment for goods or services before they are provided. This payment is recorded as a liability since the business has not yet earned the revenue. The purpose is to match income with the period in which goods or services are delivered, ensuring accurate revenue recognition. Next off is deferral of expenses. That's uh, similarly a deferral of expenses occurs when the company pays for goods or services before receiving them. These payments are recorded as assets because they provide future benefits. The expenses are recognized in the period when the goods or services are used, aligning cost with the revenues they generate. Next is accrual of revenue. Accrual of revenue happens when a company earns revenue for goods or services provided but has not yet receive the payment. The revenue is recognized when it is earned, not when payment is received. This method provides an accurate reflection of the company's financial performance. Accrual of expenses. Accrual of expenses occurs when a business incurs expenses that have not yet been paid. These expenses are recorded in the period they occur to ensure they are matched with the related revenue. Common examples include utility bills and wages. Next off is depreciation. Depreciation is the systematic allocation of the cost of fixed assets over its useful life. It reflects the wear and tear, usage, or obsolescence of asset over time. Depreciation ensures that the cost of an asset is matched with the revenues it helps to generate during its useful life. We're moving on to step number 6, preparation of an adjusted trial balance. After making the necessary adjusting entries, an adjusted trial balance is prepared. This step ensures that all adjustments have been properly recorded and that total debits still equal to total credits. Next step, step number 7, with the adjusted trial balance in place, now financial statements can be prepared. These include income statement, statement of retained earnings, and the balance sheet. Each financial statement provides a different perspective on the company's performance and financial position. Step number 8 is closing entries. Closing entries are made to transfer the balance of temporary accounts such as revenues and expenses to the retained earnings account. The process resets these accounts for new accounting period and ensures only permanent accounts carry forward. This is achieved by using an income summary account, which is ultimately closed to the retained earnings. Step number 9 is prepare a post-closing trial balance. Once the temporary accounts have been closed, the final step in the accounting cycle is to prepare a post-closing trial balance. This ensures that only permanent accounts remain open for the next accounting period, providing a clean slate for the future transactions. Finally, to conclude this presentation, each step in accounting cycle is essential for accurate financial reporting. By following these 9 steps, businesses can ensure their financial statements are reliable and useful for decision making. Now it is time to for apply these steps in practical exercise.